The Truth in Lending Act, also known as Regulation Z, is a federal law enacted in 1968 to protect consumers. Specifically, TILA was designed to make sure consumers are provided with various types of disclosures by creditors when the consumer is looking to take on debt. After the recent mortgage crisis, the Consumer Financial Protection Bureau, or CFPB, was tasked with making various changes to TILA to improve the disclosures and provide the consumers with additional time to make an informed decision. There are three main requirements for lenders under TILA, which are 1. The disclosure requirements, 2. The 3-day right of rescission, and 3. The advertising guidelines. In this lesson, we will discuss the three requirements of TILA and how those requirements can impact you as a real estate agent. When you think about TILA, it is important to remember the law is in place to ensure the correct disclosures are given to the borrower so that they can make an informed decision. Put simply, the law requires certain disclosures be made to the borrowers so that they understand the actual cost of borrowing the money and have the opportunity to compare offers with other lenders. Before TILA, consumers could be pressured at the last minute to agree to additional charges in order for the loan to be funded. As an agent, when you are discussing the loan process with a client, it is important to remember that TILA does not regulate the actual cost of borrowing. It just dictates the information that must be disclosed to the client about the cost of borrowing. There are 5 different types of loans that are covered by TILA, and they are residential, federally related, 1 to 4 family properties, non-commercial properties, and family farms. Commercial transactions are not covered by TILA. TILA requires lenders to disclose all finance charges, including the true annual interest rate, before the buyer can enter into the transaction. In October of 2015, new rules were put in place to further protect the consumer from entering into a transaction in which they were not aware of the real cost of lending. The new rules include the TILA Respa Integrated Disclosure Rule, which requires the lender to disclose particular information at certain points in the process. The first disclosure, which is called the loan estimate, must be made 3 days after the purchaser submits specific information to the lender. Once the following information is provided to the lender, the first disclosure must be made: name, income, social security number, the address of the home they hope to purchase, an estimate of the home's value, typically the sale price, and the amount they want to borrow. The second disclosure that needs to be made is the closing disclosure, which is often referred to as the CD. This is the disclosure that as a real estate agent you need to be most familiar with to avoid closing delays. The lender must deliver to the buyer the closing statement 3 business days before closing. The 3-day period gives the purchaser the opportunity to review the final numbers and compare them to the original loan estimate. If a change is made to the closing disclosure that impacts buyer's cost of lending significantly, the disclosure must be redelivered and a new 3-day review period is triggered. The 3 top changes that trigger a new review period are as follows. 1. The APR increased more than 1/8 on a fixed-rate loan or 1/4 on an adjustable loan. 2. A prepayment penalty is added. 3. The lender changes the type of loan. For example, if the borrower applies for a fixed-rate loan and then within the 3-day period it is switched to a new loan, such as an interest-only loan, the review period is triggered. Let's take a moment to review how this might impact a buyer's settlement. If the purchaser is scheduled to close on Monday, April 1st, then the disclosure must be delivered by March 29th. If the lender only provides the disclosure on March 30th, then the buyer will not be allowed to settle until Tuesday, April 2nd. As a real estate agent, it is important to check in with your client and the lender to ensure the disclosure is sent out on time. The second crucial aspect of the TILA is the borrower's 3-day right of rescission. This right covers people who are refinancing or taking out a home equity line. It does not cover the purchase of a home. To put it simply, if you are using your home as collateral, then, under TILA, you are guaranteed the right to change your mind within 3 business days. There are certain events that must take place to start the 3-day period, and they are as follows. The credit contract has been signed. The borrower has received a closing disclosure. The borrower has received 2 notices explaining the right to rescind. Once all 3 of these events take place, the clock starts ticking, and the review period is 3 business days. In the notice the lender provided to the borrower, there should be instructions on what they need to do if they want to exercise their right. If for some reason that is not included, the borrower should put in writing their intent to rescind and send it in a manner that the paperwork can be tracked. Important note: it is imperative that real estate agents remember that when it comes to all things TILA, business days include Saturday, even if the lender is closed. Let's take a look at an example in which the right to rescind might come in handy for a client. As a real estate agent, you might have clients who simply could not find the perfect home. So, instead of buying, they decide to add an addition to their home. In order to do so, they take out a home equity loan to pay for the addition. One day after closing on the loan, the perfect house comes on the market. Under the 3-day rule, they can cancel the loan and move forward with the purchase of their dream home. The rules under TILA for advertising are also important concepts for real estate agents to be familiar with. The law outlines that when certain words or phrases are used in an advertisement, often referred to as trigger words, will result in the advertiser needing to make additional disclosures. Here, we will review the trigger phrases and discuss what additional disclosures each one triggers. There are 5 main triggers. 1. The amount or a percentage of a down payment. 2. The number of payments. 3. The length of time for the repayment. 4. The amount of any payment. And 5. The amount of a finance charge or stating that there is no charge for credit. One common misconception is that no down payment is a trigger, when in fact that is not the case. It is important to remember that if any of the 5 triggers is mentioned, then all of the following must be disclosed. The terms of the repayment of the loan, the annual percentage rate and any potential increases, the total finance charge, the total number of payments and the date those payments are due, and the amount or a percentage of a down payment. In order for a lender to be subject to TILA advertising guidelines, they need to lend funds at least 25 times on an annual basis, and/or 5 loans a year must be housing loans. This is important for real estate agents to remember. For example, let's say your buyer sees an advertisement for a lot by owner with the words, "Own the land in just 3 payments." Due to the fact that this owner is not subject to TILA, he or she is not required to make additional disclosures. As a real estate agent, you will want to make sure your client has all the necessary information on the transaction before moving forward with any type of seller financing plan. Now, we will review the penalties if the rules are violated. When the changes to TILA became active in October of 2015, lenders worked hard to make sure their policies were in compliance with the new regulations. One of the reasons the banks and lenders worked so hard is the penalties for non-compliance of TILA are steep. If a lender fails to deliver the proper disclosures, they can be held liable as follows: actual damages the borrower incurs as a result of the failure to disclose, and statutory damages as defined by law, which typically range from $400 to $4,000. As a real estate agent, you will be most concerned with the actual damages suffered by the borrower. For example, if the lender fails to make a disclosure to a borrower at the time of the loan estimate and the borrower signs a contract based on that estimate. When the borrower goes to close on the house, they realize certain charges are due, and the borrower is not prepared to deliver the extra funds at closing and must default on the contract. The borrower most likely loses the earnest money deposit being held in escrow, and this would be actual damages suffered by the borrower. The major fines are levied by the Consumer Financial Protection Bureau in one of 3 tiers. The first tier violation penalties can run $5,000 per day per violation. Second tier violations are considered reckless actions that will cost the lender $25,000 per violation per day. Finally, third tier violation will cost the lender a whopping $1 million per day per violation. Third tier violations mean the lender knowingly broke the rules. As a real estate agent, having a reputable network of lenders to recommend to your clients will help them avoid lenders who violate the rules under TILA. For the last part of this lesson, we will review how the TILA impacts your day-to-day activities as a real estate agent. TILA was designed to help ensure consumers are provided with appropriate information prior to entering into a loan agreement, and the lender is ultimately responsible for ensuring the information is provided. However, as a real estate agent, it is imperative you are familiar with the rules to help guide your clients to a successful settlement. As an agent, you should be familiar with the lender's requirement to provide the borrower with the final closing statement 3 business days before settlement. A good agent will confirm with the lender, client, and settlement company that this occurred prior to the deadline. If you are the agent representing the seller, you should confirm this information with the buyer's lender and agent to ensure your seller will be able to close the transaction as anticipated. As an agent, it is crucial that you provide the lender with any credits or commission changes that need to be approved for the closing statement in ample time. If a last-minute credit comes up, it could potentially change the closing statement enough that a new 3-day review period is triggered. Under TILA, the settlement agent must provide the lender with certain financial information within 10 to 14 days of closing. As an agent, it is imperative you provide the settlement agent with your commission, administrative charges, commission credits, and license information in a timely fashion so that the title company can be in compliance and provide this information in time to the lender.